Huh? You've been a part of that before? What? Girl? What? Is it the same people? Same question? That part I don't know, but I know it's definitely not the same people. Wait, you made this? But, I mean, it ain't nothing to be nervous about. It's not, because some of the people that are in there, I know them personally, because I want to say I recommended them to be in there, and they're unbelievably nice people. I don't know who all of them are, I just know a few of them that are in there. But, yeah. Okay. Accounts receivable. We taking note because we got to run through. It's 10:53. So we already know what accounts receivable is, right? And we know selling on credit. This particular example, it says sales on credit. July 1st, TechCom had a credit sale of $950 to Comp Store and a collection of $720 from RDA Electronics for a prior credit sale. So we're talking about two different customers here. And the first one, a sale on credit, we just simply debit accounts receivable for that customer, and we credit sales for $950. And then the second transaction was where we collected for previous sales that had been made. So we debit cash for $720 and we credit that customer's accounts receivable account for $720. So how does the ledgers work? You have one big ledger account, right? General ledger account. And then you have the two different accounts receivable ledgers for one RDA Electronics and one for Comp Store. And so for every transaction, you just put them on their different receivables ledgers, and they all should total up to that balance that's in the accounts receivable general ledger. So sometimes companies will allow customers to pay with credit cards, right? And that's based upon, whether or not the company deems it's acceptable to accept credit cards. And what they'll do is with the credit card companies that they typically pay processing fees to is the credit card companies will either advance them the cash that they made from their credit sales, or they'll make them wait an additional 30 days to get the cash from their credit card sales. So it says customers' credit is evaluated by the credit card issuer. The risk of extending credit are transferred to the credit card issuer, meaning if I'm a company and I had $500 in credit card sales and you as the credit card issuer said, I'll give you the $500 up front, that's taking a risk, right? Because what could happen in the meantime? Well, not necessarily bankrupt, but those are credit card sales, meaning to be received, right? So you're advancing me $500 and you don't even know if all of my customers are going to really come through with that $500. So now you might be potentially stuck with being out of $500, right? So that's the risk that they incur. It says sales increase by providing purchase options to the customers. Obviously, if you're doing credit card sales, that gives the customers more options than paying by cash or check. And then cash collections are a lot quicker with credit card sales. So here's an example. On July 15th, TechCom had $100 of credit card sales with a 4% fee. So that means the credit card issuer is charging them 4% just to process that $100 of credit card sales for them. And then it says it's $96 cash is received immediately on deposit. So all that said was the customer did $100 in credit card sales, and in exchange for the credit card issuer immediately paying them that $100, they charge them a 4% rate to get it to them right away. So they paid $4 to go ahead and get the cash for those credit card sales. Yes, ma'am.
So the credit card company is the one who assumes the risk, right?
Mhm.
Okay,
Mhm.
okay.
And we do too, because even though we got the money, some credit card companies are getting smarter. They're doing chargebacks.
Yeah.
So, it is a risk, but then again, it's not. So they're paying this 4% fee just to get their credit card sales in advance. Cash, we debit cash, and we also debit credit card expense, and we credit our sales for the full $100 we made. Now look at this. It says now instead, TechCom, which is us, must remit electronically the credit card sales receipts to the credit card company and wait for what? The cash payment. So they're still being charged the 4% because they processed the credit card for them. So it's like I'm still going to charge you either way. But instead, I'm not going to give you your cash right away. I'm going to put it on a receivable to be received maybe 30 days from now. So we show a debit to accounts receivable, $96, a credit card expense, $4, and then sales. But then down here, what happened? This is when we actually got the cash. So this is when it was on the receivable, and this is when it, are you keeping time? And this is when it was cash received. How much?
I got it.
Oh, wow. Okay. So sometimes customers pay in its installments, right? So it says amounts owed by customers from credit sales for which payment is required in periodic amounts over an extended time period. The customer is usually charged interest. So it says down at the bottom, just a little blurb: Ford Motor Company reports more than 70 billion. Who has Ford?
We do.
70 billion in installment receivables. So we got two methods in order to write off. Why do we write off receivables? Why do you think we write off receivables? What's the main reason?
To balance.
To balance, yeah. But what would be an incentive for you writing off receivables? Mm-mm. It's really to get it off your books because it's an expense that you can't afford to keep, right? We're talking about customers who may not pay you for the year. So you write off to get it off of your books so it doesn't show that you just have a bunch of bad debt sitting on your books. Yeah, question for you, Mr. Banks.
Yeah, I did, but I didn't read my hand. You know what? I'm trying to figure out something. So is that what companies do when they or say you have debt to a company and they say, okay, they turn it over to a credit collector to clear their books?
Mm-hmm.
Is that part of that?
Yes. On their end, it would be them writing it off and writing it over to a collection agency. And in the event that the person does pay, they pay that collection agency a fee just for getting it, and then they get the rest of the money.
See, I thought they sold it. I thought that
It's not really a sale. It's more so I have $5,000 in outstanding receivables. In April, if your company can collect that $5,000 for me or whatever you can collect for me, I'm gonna pay you whatever your percentage is to keep. You're basically saying, okay, well, I collected for you, but I get to keep 20% of it.
So, but if it's already written off, then how do they?
That's what I'm gonna show you. You have to reestablish just in order to receive it. You had a question?
Ma'am, I had a question back to you about the $4 that's being paid from us to the credit card company for them
To process credit card.
process the transaction.
Mm-hmm.
But that's not something we pay up front. That's taken out of the payment.
Correct. So direct write-off method, which is the most easiest but not the most beneficial when it comes to balancing the books every period. Direct write-off would mean you accept it as a bad debt, so therefore you write it off directly as that. This particular example, they determined on January 23rd that they cannot collect $520 that is owed by this customer. So since they have determined that they can't collect it, they're just going to debit bad debt expense, and they're going to credit that accounts receivable account and completely get it off the books. Okay. But what might happen sometimes is that a customer, after you've written it off, will come back and say, hey, here I am, here's my payment. So what you have to do is reestablish it again and then collect the money.
Is that a separate?
These two
Ledger?
separate transactions, same ledger. So let's just say that customer, we wrote it off, right? Because we
Right.
said we weren't going to collect it from him.
Right.
So now he comes back and said, here's the 520.
Right.
Well, I no longer have his account in my books anymore. So now what I have to do is treat him as if he's a brand new customer again and reestablish his account all over again. So I have to debit accounts receivable for him and credit bad debt expense to take it out of there. And then I show I received the cash for that 520 and then credit his account again. Bless you. So I closed it, he came back and paid it, so I had to reestablish his account first, then receive the cash he was paying.
So it doesn't matter.
So that 520 would have already been taken out of accounts receivable and put in the write-off account, which is bad debt.
Correct.
Right?
Correct.
Okay. Okay.
And then he came back and paid it, so I had to create his accounts receivable all over again. And I had to take that money out of bad debt, and then I had to show that the cash has been received. Now I'm gonna tell you what this does. On the customer's behalf, obviously it's not favorable, right? Because they waited so long to pay me that I wrote it off thinking that I wouldn't collect it. More than likely when I collected it, it was a whole nother year, later. So that's causing extra work on my behalf, which means when it's time for that customer to come back and possibly purchase from me again, I probably will not extend credit to them because they're not worthy of paying on time. Okay? How is that different from the allowance method? This right here is talking about matching versus materiality, and I'll explain both. We know the matching principle means you match expenses in the same period in which the revenues occurred for those, right? Materiality, that's something you're not really familiar with, but I'll tell you. Let's say I'm a small company and I balance the books and it's off by $30, but I'm a multi-million-dollar company. Does $30 really affect any decision that I'm going to make?
No. No. No.
If I'm a multi-million-dollar company and I'm off $30,
No.
$30 will not
No,
dictate
sorry.
me changing the decision, right? But what happens if I'm missing $100,000?
Yeah.
That's material. That's the difference between materiality and immateriality. Immateriality means the amount is so small and insignificant that it will not change the effect of decisions being made.
So is there an amount that, like?
It might be depending on the business. Yeah, the company has to come up with that based off of what their net sales are, what their revenue is, what they perceive their revenue may be. They might set it at a certain amount. Like, these Fortune 500 companies, to them, $1,000 or a couple of thousand is not significant.
So they have an allowance already set up that says $50,000.
They just have a clause that says anything between $0 and maybe $10,000 is immaterial. Anything above $10,000, we need to investigate where that money is.
Okay.
So what you'll notice in some of the annual reports do state that. They'll say, materiality was found, this was the statement that it came from, this was the account, this was the amount of money difference that we're missing, and that was funded to this or funded to that. But you just need to know the difference between what is material and what is not material. Okay? And it's an amount that's going to change the effect of or the decision making of a company. So the allowance method, which is a little different, it's more accurate. But the allowance method allows you to estimate bad debts in a period, even, and that's going to be in the same period when sales are actually recorded versus when you just write off a bad debt. You might not write it off in the same period in which the sales actually occurred.
Right.
Those sales might have occurred a year before, a year prior, a couple of years prior. So with the allowance method, you get to write it off in the same period in which the sales related to it were recorded. And it allows you to report accounts receivable on the balance sheet at the estimated amount of cash to be collected versus what actually was collected, because it's an estimate. So this is what it looks like.
Well,
I'll tell you why. We'll get to it. They had credit sales here of 300,000, right, in the first year, and at the end of the first year, they had how much on credit sales that were uncollected? 20,000. Now, based on their experiences with similar businesses, they just basically estimated that even though that 20,000 is uncollected, out of that 20,000, I'm going to say that 1,500 for sure will not be collected. So what they do is they take that 1,500 and they debit bad debt expense and they credit what? That's an account you're not used to. Allowance for doubtful.
Oh, wow.
Read in your book what allowance for doubtful means. And tell me.
Contra asset account?
Tell me what it says in your book.
It says, the allowance for doubtful accounts is the contra asset account.
Contra to what?
Contra account is reducing accounts receivable, regular purchase accounts,
And what's its purpose?
Just the balance, right? What's the contra account?
It is a contra account. However, what is the purpose for allowance for doubtful? It should tell you that. What did it say there is the purpose of allowance for doubtful? You're leaving out.
Oh, that's the one. It says you don't know which customer.
Y'all wish you luck.
Good luck.
Bye-bye. Okay. Go. I'll explain it. Thank you. All right, so allowance for doubtful, the purpose is being able to write off an amount for bad debts without tying it to one single customer. Remember when we did the direct write-off method, we directly wrote off that amount to a customer, right? Because we knew who it was for. In this situation, they're saying $1,500 is uncollectible. We don't know who that $1,500 belongs to. We just know it could be a combination of people. It could just be one customer for all we know. But 1,500 of it for sure.
It's like a petty cash.
Mm-hmm.
Debt, bad debt.
It's bad debt. It is bad debt. But it's saying, I am doubtful of who this actually belongs to. So I'm going to put it in this account because some of these customers or all of these customers may come back and pay. I just don't know who it is. So I'm going to estimate this amount and put towards that little area so that whoever does come and pay, I'll know, okay, this is no longer bad debt, this is no longer bad debt, so forth. Whereas directly writing it off is saying, Amanda owes us $500, and I know for a fact I'm not going to collect from her. I know just her. I don't know who else is uncollectible at that point. So in this case, they determined that 1,500 was uncollectible. So they credit the allowance for doubtful accounts for 1,500. Debit bad debt expense. And this is what it looks like now on the financial statements up under current assets for accounts receivable. That 1,500 being deducted from 20,000, which says now that accounts receivable should be 18,500. Now, this same little lonely customer decides to come back and, pay. So first we wrote it off and we put the 520 in allowance for doubtful, and we credited his accounts receivable account to cut it down, to shut it down and cut it off. Yes, ma'am.
This might be totally off topic, but when when you're using the other one where he is directly affected by it,
Mhm.
that goes against his credit. But if you use the doubtful account,
It still goes towards him if he is part of that group of
it's still
money.
affecting his credit.
Right, because notice for him, it's only $520. It's not $1,500. So the remainder of that $1,500 is still out there. We don't know what customer belongs in there. Does that make sense? We wrote out $1,500 in allowance for doubtful.
Yeah, but it didn't go to a collection agency, so it's not affecting J. Kent's credit, right?
No, we'll take the collection agency off the table. We
Okay.
use that in real life, but that's not what they're trying to do here. What they're saying here is we took $1,500, we put it in the bucket for doubtful, allowance for doubtful. And we said we don't know what customers are a part of that $1,500, but we just know $1,500 of it we are not guaranteed to collect for the year.
That's estimated, that's an
Estimated,
estimate.
it's an estimate. That's what allowance for doubtful allows you to do, is estimate what you think is gonna be uncollectible versus bad debt expense. I know for a fact, this customer, that customer, that customer, I will not be able to collect on. So I'm gonna directly write that off. Okay? In this instance, we wrote him off because he became one of the customers that we knew we wouldn't collect from. So what happened? He didn't make up that full $1,500, right? He only made up $520 of that $1,500. So what did we do? Accounts receivable was wrote down to $18,500, right? After we wrote it off, our allowance for doubtful accounts no longer was $1,500; it was $980, right? And if you subtract $980 from $20,000, that gives us $19,480. So this is the same situation. This guy came back and paid. We had to restore it, then accept his cash for paying it. What time are we? All right. We have to stop here.